Good morning, folks, and welcome back to Almus Market Mornings. The focus squarely is on the geopolitical updates coming out of the Middle East. The Red Sea corridor, which came out as a workaround for oil exports, especially for Saudi Arabia, is under attack. The Houthis from Yemen targeted two oil tankers yesterday in the Red Sea, which was also confirmed by the UK MTO. Brent oil prices have crossed the $95 per barrel mark. On the other front, the risk assets, it has continued to face challenges emerging from the US earnings season after Alphabet, which is Google's parent company, announced a bigger capex than what was being expected, while Tesla has missed on earnings estimates as well. The chips boom, though, has helped the South Korean economy as it grew faster than what was expected in the second quarter. Rupee had another day of weakness, crossing the 96.50 mark with limited support from the central bank. So, looking at the rupee weakness, there's a one very important pertaining question to ask to JK. Uh, Morning, sir. So, we have had multiple risk aversion scenarios playing out. Do you think we would still receive as much flows as which is being anticipated under the FCNR scheme?
Good morning, Swaraj. So that is more of an optimistic thought because one, I think the response so far, although RBI has given data showing 20 billion overall inflow, how much more that we can get compared to the initial expectations is a big question mark because now the yields in US are also going up further and uh, possibly the investors prefer the safety of the US treasuries at near about 5% for 10-year and 4.5% for 2-year yields. So that could be a challenge to get the flows more. I think it is still up a toss how much we get. That's why markets remain cautious on the rupee as well. Yeah, we do, of course, have RBI snooping on the upside above 96.50. But everyone knows that, with reduced reserves, RBI's, aggressiveness in intervention could be limited. And possibly we are now slowly moving once again towards, the previous all-time high at 96.96 because now increasingly we are seeing exporters are keeping away and import buying is quite heavy. Only positive factor that we are seeing is this month again the FI flow have been decent enough. We have already got about 4.7 billion, and that includes the equity as well as the bond market. So I think eventually flows will be determinant for the rupee, and it's difficult for me right now to answer your question. How much we will get and whether it will have a positive impact. I think it's something wait and see because far too many factors are at play. But on the geopolitical front, tensions have risen after, and the another alternate sea route has also been blocked by Iran-backed militants. More and more ships are turning back, not able to proceed. And matters were not helped with President Trump's threat to retaliate against Iranian attacks on shipping by striking their infrastructure and also warning that they would be targeting the bridges and other infrastructure in the Iran, and that's also provoked response from Iran that any such action would also invite their reaction. In a much larger way with the on the US bases in the Middle East. So the tensions are not easing. So we are having the oil which is on the boil. Oil market has actually a dual problem now. Prices have spiraled more than 30% in less than a month. And importantly, physical tightness could actually lead to crippling economic activity if it continues for long. Markets have seen the yields move up once again. 2-year yield has hit 4.31%. This is the highest since February 2025. And it was in February 2025 that Fed rate was at 4.5%. exactly where some of the hawks in the Fed want the rates to be from current level of 3.75%. So market is also trying to assess whether the conditions which are driving the yields higher continue to influence particularly the capex related demand for money, as well as the treasury trying to raise more and more money to meet their bond maturities, which is, I think, the amounts are substantial to give some jitters to the bond market. That's why investors are demanding higher premium for holding long-term bonds. At least for now, the stock markets are still taking these things in their stride, not seen any collapse. Of course, higher volatility in Korean market is more due to the domestic regulatory moves. But otherwise, I think we have seen much less volatility in the US market, particularly in the Nasdaq, which has moved in the last 1 month, not more than about 8% range. So we are still stable there. And a reaction to the data from Google and other companies yesterday was also somewhat muted, I would say, because we still have to get numbers from major companies like Facebook, Amazon, and Microsoft, all these things numbers, and of course the most awaited number would be the Nvidia numbers, because that is where all the action is. So that's the reason why markets. But if you ask me, I think the rising yields with higher capex, which again Google has already indicated. All these things eventually is going to be a negative for the markets, and I think it's probably now lesser participation, lower volumes that is keeping the market subdued. But eventually, I see markets undergoing a deeper correction. Perhaps the timing is yet to come. On the currency front, also, we have the euro awaiting ECB decision today. ECB kicks off the series of major central bank meetings. Next week, we have the Fed and the BOJ, eventually also Bank of England. ECB is not likely to change the rates today. They're not going in for a back-to-back hike because the economy is still fragile. Possibly we have one more rate hike in September. So I think at the same time, ECB will be very mindful of how the inflation proceeds from here, as the oil prices in general, as well as the natural gas prices, which Europe depends heavily upon, also is on the rise. So we expect no change, but ECB statements, as usual, will be the focus. In general, the dollar is holding a tight range. We're waiting more developments on the bond market, as well as the Middle East situation. You see, normally the bond yield rise would have seen dollar rise much more than what we have seen. Although yen has crossed 163 as well, but there is no momentum that we have seen in the currency. So the reason why markets are not reacting much to the bond yield rise is that yields are rising everywhere. That's one factor, and also market trying to assess which economy is likely to withstand higher rates in the months to come. So that is where the suspense lies, and possibly as of now, U.S. economy seems strong enough to rather withstand the higher rates. But I think if the bond market goes into a toss, yields rising above 5% for the 10-year, etc., then I think we will have a bigger problem for the US, because they are running the highest deficit, as well as the debt around $40 trillion. So markets watching what kind of policy decision will come if yields go to that extent. Of course, yesterday there was a statement from, or rather a news item saying that the BOJ could be going in for faster pace of rate hikes, where the market had a limited reaction to that. falling about 0.5% in the USD, but then back above 163 because market is caught between the higher yields, which could become attractive for the yen, but then the fiscal concerns are greater right now. That's why the yen remains on the weaker side. Surprise move in the gold in the last few days, rising from below 4,000 to almost 4,200 mark yesterday. And this is also surprising in the context of yields rising, because all along we have seen that gold has been sold as and when the yields are rising. But then this time I feel the investors are shifting support of their bond holdings, investments into the gold as well, some sort of a diversification that's supporting gold as well. For the rupee, yes, it continues to be a challenge. I think, as I said earlier, 96.30 is now providing a good base, and a gradual move towards 96.70 and towards all-time high. One should be prepared for it. Thank you.
Thank you, Jake. And yes, so for the rupee, as of now, as we discussed in the past few podcasts, also that the global scenario remains quite unfavorable with respect to flows. The FCNR as of now, the attraction is limited because yields everywhere is rising. So actually, the spread between US Treasury and what FCNR is offering is also limited, and investor sentiment may also be a bit subdued in this kind of environment. So we are facing challenge all around, and moreover, the central bank itself has a reduced reserve due to the large short forward book, and it looks like we are moving to an all-time low level for the rupee. Exporters have also generally kept away, and importer demand is quite steady. And we have the more importantly ECB meeting today. It kicks off the central bank meeting spree, Fed and BOJ next. It is next week. So ECB, but this in this meeting is unlikely to hike rates. Otherwise, currencies remain in a tight range. Dollar index holding 100.5 above 100.5 comfortably. Dollar JPY trades comfortably above 163. Gold has risen substantially in the past few days despite yields rising, which is an interesting occurrence. That's it from us today. Thanks for listening. We will catch up tomorrow with a fresh round of updates.